Hello there. Welcome to Trading Day. The TSX Composite in record territory. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. The economy saw a rebound in the third quarter, exceeding expectations. Data from StatsCan indicates that gross domestic product rose 2.6% at an annual rate. Driven, though not by business investment, the big factors were government spending and residential investment. Trade, however, showed signs of weakness. Imports fell almost 9%, the biggest decline since 2022, and that actually inflated the GDP number. The imports were dragged lower by a drop in shipments of metals. Exports edged higher. In a flash estimate, StatsCan says the economy shrank in October by 0.3%. Alberta is lifting its 2025 gross domestic product forecast. The economy is now expected to rise 2.1% this year, while 2026 growth is expected to moderate to 1.8%. A budget update by the province also signals lower borrowing needs compared to the first quarter. The province's deficit is expected to be $6.4 billion for the 2025-26 fiscal year. Shares in Tilray sliding today. The cannabis company says it will implement a 1-for-10 stock consolidation effective December 2nd. Tilray says the move will make shares more attractive to investors and is aimed at cutting expenditures related to its annual shareholder meeting. The company claims it will result in up to $1 million US in cost savings annually. And there's a look at the TSX in record territory once again, up 23% in the past 12 months, excluding dividends. And U.S. markets hanging in, broadly speaking. Today, it is, of course, a quiet session because of the Thanksgiving holiday yesterday. So we have seen strength in markets this week after a sell-off last week. Our guest argues that quality-focused value investing has been out of favor in recent months, but he argues that patient investors will ultimately prevail. We're joined by Jason Del Vicario, portfolio manager at Hillside Wealth Management at IA Private Wealth. Jason, great to see you. That's your case then. You think value investing has just been out of fashion, investing in stable, high-quality companies?
Yeah, I mean, there's been a bit of a bifurcation that we've noticed in the markets that really started around sort of July, late summer, where the types of predictable, sustainable, quality, sustainable return on equity, founder-run, founder-owned, the types of businesses that we favor at Hillside to own for our clients for the long term, were really kind of taken out back as investors clambered over themselves to buy the likes of NVIDIA and the AI and Bitcoin and gold and so on and so forth. But at the end of the day, cash is king, cash flow matters, and we think that ultimately that patient investors, as you noted in your introduction, will be well rewarded over the long term.
You like to avoid companies that avoid competition, I guess, particularly on price. Yes. How would the AI companies fit into that thesis?
Quite frankly, I'm not that familiar with the AI companies. I think when you have a boom like this, you probably do want to invest in the pick and shovel, so to speak. So I think NVIDIA certainly is a leader. I believe they have something like 90% market share. So that would fit within the context of avoiding competition. The concentration of their revenue, I think, could be a concern. I've read reports that upwards of 60% of the revenues come from just 4 customers. And of course, the repeatability or the recurring revenue nature of their products and not really much service revenue would also give us pause. We like to own companies where there's frequency of purchases or frequency of activity. And for us, we like to bet on the winners once the race has started. To us, it's not really clear yet who the winners will be in this AI trade, so to speak.
Are we in an era of speculation and hype aimed at investors?
It feels that way. Again, I mean, when you see a lot of money going towards companies that either have no profits or trading at 50 to 100 times earnings, I don't see how you could conclude otherwise. But I will say that when we think about bubbles, when everybody is talking about there being a bubble, that's usually a situation where there isn't a bubble. So the fact that many people are talking about an AI bubble or a tech bubble today, my contrarian sort of radar antennas get triggered, and just from that perspective, I would suspect that we're probably not in a bubble yet. It's when everybody just assumes that things will only go higher, that whether it's AI or tech is really the only way forward, and these are only the types of investments to hold, and complacency sort of rears its head. That's probably when we will be at sort of peak speculation. So just from that little tidbit, I'm not convinced or prepared to say that we are or aren't in a bubble at this time.
On the theme of being a contrarian, Constellation Software, you think investors have been too hard on this stock?
I wouldn't necessarily say that investors have been too hard. I mean, this is an example of a company that was very richly valued, trading at over, say, 50 times earnings, and has now come back down to around 30 times. You might not see that when you pull up a Yahoo Finance or a Google Finance. You do need to make some adjustments to their earnings to look at what their actual cash earnings are. But this is the first time in 10 years. I mean, it was 2014 when I first featured Constellation Software as a top pick at around $250. And I haven't since then, not because we don't own it, not because it's a large position for us. It's just that between now and then, it has been relatively expensive, and it has since now come down to a level where, especially if you don't own shares, if you've been watching Constellation for a number of years and always thought it was a bit expensive, I do think that current levels offer reasonable value, not exceptional value, but reasonable value for those who don't own it or perhaps would like to add to their positions. And I would also throw in Topicus and Lumine, which were their two spinoffs. They have been sold off quite a bit as well. I mean, I could go over why they've been sold off. Obviously, Mark Leonard has stepped away due to health reasons. People are concerned that everybody's now going to be able to develop software on their own using, large language models. We think that is certainly overdone. And as you noted, I think that the shares have sold off more than certainly is warranted, given the business fundamentals and the unit economics of this business, which, again, is exceptionally well run.
A stock that has suffered lately, Novo Nordisk, the Danish weight loss drug giant. Investors seem to think Lilly has won this race for now.
Yes, in the short term, Eli Lilly has certainly been eating their lunch, at least in the U.S. market. If we look outside of the U.S., Novo Nordisk is still clearly the market leader, both in terms of diabetes, insulin care, as well as obesity care. I mean, the stock is down, I think, something like almost 70% from its all-time highs, trading in the low teens with a reasonable dividend yield. Let's still not forget that this is a duopoly. So Novo Nordisk is not going away. They're a 120-year-old company. And we think that shares at current levels represent tremendous value. But obviously, there's going to be some volatility in the near term. And we've been accumulating shares over the last few months here and feel comfortable with the position that we have.
Jason, thank you very much indeed for giving us your thesis there. Jason Del Vicario, Portfolio Manager at Hillside Wealth Management at IA Private Wealth. Up next, we got a rising need for housing Canada-wide. The crunch is especially acute in Indigenous communities. We're going to talk to a player in the industry who is innovating, and it includes moving houses on barges. We'll be right back. Ottawa has been looking to invest in building more homes that are ecologically friendly and also to create more Indigenous partnerships in the housing area. One BC company is combining those needs to repurpose homes that were set for demolition and taking them to Indigenous communities in need of housing. We are joined by the CEO of Renewal Development, Lynn Lewis. Lynn, thanks very much indeed for joining us.
Thanks for having me, Andrew.
Tell us what you're doing to help remedy the acute shortage of housing in Indigenous communities.
It's a great question. So we know that there's a critical shortage of housing all across Canada, but that's particularly acute in rural, remote First Nation communities. Mm-hmm. And if you go up and down the coast of British Columbia, there's hundreds of remote, rural, small Indigenous communities that need good, affordable, climate-resilient housing. And on the flip side, the real estate industry here in Metro Vancouver and in Greater Victoria is tearing down thousands of homes, single-family homes, to make space for higher density development. So we know that there's an incredible supply of good homes being torn down across the region, but we also know that there's an incredible need for good housing in some of these remote First Nation communities. And our work as a company, Renewal Development, is to bridge those two opportunities and needs.
I mean, that's the thing that used to happen in rural Canada a century ago. I think people would move houses rather than rebuild. But tell us, in the modern age, what's involved technically in picking up a house and moving it?
Yeah, I mean, there's certainly a lot of engineering, a lot of planning, and there is some complexity to what we do. We have to find and assess all of these homes that are slated for demolition, and we assess them for their condition and their quality. But we also have to assess to make sure that we can physically move them. We're picking up buildings that are 30, 40 feet wide and 50, 60 feet long and trying to move them through our urban streets. And eventually we mostly move these homes by barges. So it is a lot of planning, it's a lot of engineering. It is an industry that's been around for hundreds of years. There's great stories of companies starting in the Midwest in the 1850s, 1860s. They used to move these things by horse and carriage, and now we use hydraulics and barges. And so the industry has gotten more sophisticated, but I've seen an opportunity to scale and to replicate what I think is a really innovative, sustainable housing model.
So what's involved? How do you pick up a house? Do you put some kind of a platform under it, or can you give us a rough idea?
Yeah, so the process we start with, once we've assessed the home and it's a good condition home, it's valuable and it can be moved, we add steel beams below the floor joists, and then you build a cribbing, and then you use these unified jacks, a unified jacking system, and the jacks push on the beams push on the floor joists, and that's how you physically lift the home. Once it's up in the air and the beams are underneath the home, we attach dollies, and then the dollies attach to a truck, and then the home leaves the origin site and goes down the street and eventually down to a barge, where we often move it to more rural, non-urban communities that need housing.
How do you move it through the streets? I mean, I think you said 30 feet wide.
Yeah, about 30, 35 feet wide is usually the typical width of a home we move. I guess the short answer to that question, Andrew, is we move them carefully. You have to do a lot of measurements, you have to do a lot of planning, a lot of engineering, talking to local municipalities and the Department of Transportation. But like I said, this has happened for hundreds of years, and in fact, Auckland, New Zealand is the global leaders in this. Every year in Auckland, New Zealand, 1,500 single-family homes are moved out of Auckland to the surrounding areas. And so we know that there's global leadership that demonstrate that this is a viable, innovative, sustainable housing model. And I'm really excited for our company, Renewal Development, to replicate and scale this model here in the Pacific Northwest.
I remember that scene in the Shipping News, the Newfoundland movie, where they're rockers, they're pirates who loot ships that come abroad and they get driven out. They have to push their house across a frozen lake. Do you make money at this? Is it a profit-seeking operation?
That's such a great question. So we are a for-profit company. I do try to maximize triple bottom line and looking at sustainability, looking at the social impact, looking at reconciliation with Indigenous communities. A lot of these projects, Andrew, they wouldn't have happened if it wasn't for the leadership and the partnership with a lot of these coastal Indigenous communities. So we provide a service to real estate companies, and our service is to clear their sites. So essentially we act as a demolition company for real estate developers here in Metro Vancouver and Greater Victoria. So once we secure the good homes that we want out of these sites that we clear, we provide a product to an Indigenous community or any community that needs housing up and down the coast. And so in that sense, we're essentially an innovative, sustainable, modular company that provides good housing to communities in need.
Just to be devil's advocate, would it not be simpler to just go with regular prefab homes or simply to build the home in situ?
Yeah, that's a great question. So in some of these communities, especially in some of these remote communities, there are no trades, there's no supplies or local products. We're dealing with some really remote communities where there's sometimes not even a coffee shop, Andrew. So to construct housing in a situation in a community like that is incredibly complicated, but it's also incredibly costly. So bringing in a good retrofitted, repurposed home is much more cost effective. We estimate it's about 20 to 40% more cost effective than building new housing in some of these remote communities, or to bring in other modular or prefab housing solutions.
It's interesting, yeah, fascinating that they're just ripping down these homes. I guess extra density is good, but it does seem like a waste. That's a great story, Glenn. I love that footage of the houses going on the barge. Thanks very much indeed.
Thanks for having me.
Glenn Lewis, CEO of Renewal Development. The economy rebounding in the third quarter. We'll get more from our own Lindsay Biscaya after this. On the surface, the Canadian economy showed signs of strength in the third quarter. It suggests, among other things, that initial damage from the trade war may have worn off. Let's get more from our own Lindsay Biscaya.
And a lot of economists, Andy, are being cautious about this, saying that this looks good on paper. It looks very exciting, these numbers we're seeing, but there is potentially still cause for concern in the very near future. And we're going to have to wait and see what the month of October looks like when that comes out. But we'll first talk about that third quarter GDP. The number is 2.6%, so blowing past estimates, which is why economists say this looks so good on paper. Many economists that were surveyed on Bloomberg were expecting an increase of 0.5%, and we saw 2.6%. So that is quite high. That growth was driven by investment in housing as well as government spending, particularly toward defense. And crude oil exports also contributed to the growth. When it comes to business investment, though, we saw a lot of declines there, particularly within non-residential construction, machinery and equipment, and investment in electoral property products. So those are three major categories of private sector business investment that really just kind of fell through. And this reflects kind of that environment of uncertainty as well because of the trade war, right? A lot of businesses are not investing at this point in time. And we also got an interesting note today from the Canadian Chamber of Commerce, who released a statement saying we need strong domestic demand, and we simply just weren't seeing that in this quarter. Like, people just weren't spending money.
And so we got numbers for September and October.
Yes. So we got numbers for September. So for the month of September, we did get some preliminary numbers from October. But yeah, for the month of September, we saw real GDP increase by 0.2%, which is right in line with what economists were expecting. Year over year, up a full percentage point, and most economists were predicting about 0.6% growth. So we saw more there. But as you mentioned, we're already getting those flash estimates for October, painting a bit of a bleak picture. And we were speaking with Jimmy Jean today, chief economist and strategist at Desjardins, and he was talking about that kind of flash estimate and what that can mean when we see those numbers come out in October. Here's more from him.
What we learned is that in October, GDP seems to have contracted 0.3%. So there's a lot of choppiness in the numbers, but a 0.3% negative at the onset of a quarter really suggests that that quarter will probably see weak growth. The Bank of Canada was hoping for 1%, but we've been tracking below that, and that tracking might be reduced further.
So that's going to be interesting to see. Also, another note when it comes to that GDP for the third quarter, Andy, there is a very big chance, according to Statistics Canada, that we could see a larger revision than usual, and that will come in February when it comes to that 2.6%. And that's because some of these numbers rely on foreign merchandise trade data, a lot of that coming from the U.S., and because of the U.S. government shutdown, we just weren't getting that data.
Lindsay, thanks very much indeed. Lindsay Biscaya. Okay, let's get over to our weekly look, particularly at Bay Street and finance. We're joined by Bloomberg's Canadian finance reporter, Christine Dobby. Christine writes, the Bay Street edition A weekly newsletter. Sometimes she brings a bit of attitude to it. Always great to see you, Christine. Thanks for joining us. We are going to get, you're going to be busy next week. The banks report their numbers. Yes. One thing we'll be looking out for is rising compensation. We will be seeing more Lexuses on the streets of Toronto, it sounds like.
Yes, Andy, good news for bankers, just in time for the holidays. As we know, the markets have been quite active this year, particularly, around the frenzy of Liberation Day and all the confusion around tariffs. There was just so much activity, and the markets have been fairly buoyant all year. So, and we've also seen deals start to pick up again in the United States, in particular, where some of the Canadian banks have significant operations. So, what this is all translated into so far is rising variable compensation, which is sort of a proxy for what the banks pay in bonuses, and that's particularly paid to people in the capital markets businesses. And if you look at the year-to-date numbers so far, they're tracking at about 15% higher than this time last year. You could probably expect that to continue into the fourth quarter. So yes, look for some happy bankers on Bay Street in the next few weeks.
Of course, we all rejoice when bankers do well.
We do.
Okay. This is not an entirely new story, I don't think. It's a new angle for me. There's talk of whether insurance companies should sue the oil and gas industry for climate disasters linked to global warming.
Yes, this is an interesting one. If you look at the cost of insured damages, it's going up pretty much every year because we're seeing these extreme weather events. So if you look at 2024, we had the flash floods in Ontario, wildfires in Jasper, and this really a vicious hailstorm in Calgary. And insured damages in Canada that year hit $9 billion. That's 3 times what insurers paid the year before. And there's a lot of uninsured costs that go into fixing up properties and communities after these kinds of events. And so there's a new report out this week from Climate Group Investors for Paris Compliance, arguing that insurers or governments or even individuals should bring litigation against polluters, essentially, for causing the climate change that leads to the weather events that causes the damage. So it's a little bit like the previous lawsuits that we've seen against tobacco companies and opioid makers, but there's some different science behind this.
You note that it could be a stretch trying to prove that an oil and gas giant is actually linked to a climate event.
Yeah, the link is not as direct as it might be, say, from the cigarette maker that didn't put the warnings on packages too. But there is a growing field of something called attribution science, and there are quite a few states in the United States that are pursuing legislative changes to allow for people to sue polluters. So this really is kind of, it's maybe in the early stages, but it's a growing sort of area that people are thinking about in terms of who pays for all of these damages.
Christine, thank you very much indeed. I really appreciate it. Bloomberg's Christine Dobby. You can sign up for her weekly newsletter called Bay Street Edition by going to bloomberg.com/newsletters. Have a great weekend, Christine. Coming up, 3 standout retail stock ideas. It is Black Friday after all. The Canadian economy grew more than expected in the third quarter. StatsCan says GDP increased at an annual rate of 2.6%, fueled by growth in housing and government spending. Despite the rebound, though, imports posted their largest decline since 2022, dropping nearly 9%. StatsCan said weakness in household spending also weighed on growth, and there was a slower accumulation in manufacturing inventories. Some analysts believe the data makes it even less likely the Bank of Canada will cut rates at its next meeting. Shares in Canadian gold producer Montage Gold rallying after the company agreed to acquire all of the shares of Australia-listed African Gold it doesn't already own. The transaction is valued at $170 million US and adds a key project in Côte d'Ivoire in West Africa to Montage's portfolio. Montage says the takeover will also strengthen its footprint in the country. Once finalized, the deal will see African Gold shareholders own about 8% of the combined company. TD Bank and First Horizon, the U.S. lender, have defeated investor allegations they misrepresented the approval prospects for a rushed deal in which TD was going to buy First Horizon in a transaction valued at more than $13 billion US. According to a New Jersey judge, First Horizon stockholders lack standing to sue TD for alleged securities fraud over its own regulatory compliance and commitment to acquiring the bank. TD walked away from the deal in 2023 amid regulatory concerns and U.S. money laundering probes, and that sent First Horizon stock price down. TSX hitting a new record high in trading today, boosted by precious metal stocks, in particular silver shares. They've been soaring after the spot price of that metal hit a record high. And let's have a look at U.S. markets. They too are showing signs of strength. Black Friday sales are exciting some consumers. Earlier today, we were joined by David Swartz, Senior Equity Analyst in Consumer Equity Research at Morningstar. He discussed 3 retail stocks that he thinks are standouts. We kick things off with Nike. Let's have a listen.
One day out of the holiday period, and so you don't really want to draw conclusions as far as what the Black Friday sales look like. It's also hard to get good data. There's a lot of anecdotal discussion about shopping mall traffic and things like that, but you never really know if that translates into sales until later. And so people often will jump to conclusions perhaps prematurely.
Let's get to your first idea. Nike, they, of course, are big in China. They've had their troubles, though, in recent years, keeping up with the consumer. Actually, I didn't know that. The stock is down pretty sharply in the past year. You do see potential here, though?
Yeah, I do. Certainly, Nike stock has been down quite a lot. The company really has had 2 difficult years, and that's been reflected in the stock price. But, you know, Nike still has a lot of strengths, including its connection to global sports. The company got a new CEO about a year ago, and he seems to be moving the company in the right direction. They're really focused on putting out quality products, performance products, and perhaps in the past, Nike had gotten away from that a little bit by focusing too much on the actual retail experience and moving away from their wholesale accounts. Nike right now is really trying to improve its relationships with wholesale partners, including the combined Dick's Sporting Goods and Foot Locker. And, you know, I think in the long run, Nike still has the strongest position in this market, and still a favorable market. The sportswear market is very large and global. And, you know, Nike right now, my fair value estimate is $104 a share. And so I think that for people that are willing to wait and see how this works out, I think this is potentially a good time to buy Nike. Okay.
Lululemon, a go-go stock. Maybe we'll put up a 5-year chart that did drop, something of a fallen angel. You see them getting their mojo back?
Yeah, like Nike, Lululemon's had kind of a difficult year, but you have to keep it in perspective that Lululemon's numbers are still really good for most apparel companies. The company generates very high margins. It does mostly direct selling, which is a model that really is very profitable for them. But people have been concerned that Lululemon's growth in North America has slowed. There's also concerns about the China sportswear market, which is a market where Lululemon expects to generate a lot of sales growth. But my fair value estimate on Lululemon is $295 a share. And so I think it's actually quite undervalued right now, which is quite a big change from the past when Lululemon was often very highly valued. And at one time, it traded at a PE of about 50 times. So Lululemon's valuation has certainly contracted considerably. And I think that this is a good opportunity to buy the stock at a good valuation. As a company that has no debt and generates huge amount of cash flow. And so a very strong balance sheet as well.
Has the magic gone, though, for Lululemon? I mean, could it be that, sure, they were a cult stock, they did a great job of organizing local yoga groups, but has the gloss gone off the story? And
it is true that the market itself has become more competitive, and we have seen some strong competition in the women's athleisure space. But, you know, I still think that Lululemon has a lot of fans. I don't think that people have really soured on the brand. I think that recently Lululemon has not put out enough new stuff, and that people haven't had a good reason to shop there as that they have in the past. But Lululemon has a lot of new products coming out, and I think that consumers will respond. I still think that Lululemon has a strong following, and that the company really puts out very high quality products.
And then finally, Gildan, a very different story. Obviously, they do sell some stuff under their own brand, but they're a huge supplier of generic garments as well.
Yeah, so right now, Gildan is about to close its acquisition of Hanes Brands, the U.S. Major underwear and basic apparel manufacturer. And so, you know, that's really going to affect Gildan's consumer business. It's going to be a major consumer business now. In the past, and still today, Gildan is mainly known for printwear, which is producing essentially blank shirts for the printwear market. But Lululemon's also going to be a major company now in branded basics. And so, you know, I think this is a transformative acquisition for the company, and people don't necessarily recognize this. And the stock, both in the U.S. and Canada, are trading at very large discounts to my fair value estimates. My valuation in the Canada shares is $128 Canadian. So I think that there's really an opportunity right now to buy Gildan at a good valuation with this acquisition closing, which I think is really being undervalued by the stock market.
Leave us with a final thought. What retail generally, we know there's the relentless march online. What other big trends are you seeing, David?
Well, we are seeing some trends in terms of retailers that cater to lower income consumers, and higher income consumers are doing well, but the middle class is really not doing so well in the United States, especially. And so we're seeing a lot of weakness from department stores and from retailers that cater to the middle class, but we're seeing strength in retailers such as Ralph Lauren, for example, and also Urban Outfitters labels in the U.S. That cater to higher income consumers, but also lower income consumers and middle class consumers are shopping at clearance stores like Ross and TJ Maxx in the U.S. And so we are seeing some changes, and these have really been ongoing for years, but they have continued this year and probably will continue into the future, where retailers that cater to the middle class are continuing to struggle.
David Swartz of Morningstar. Up next, small businesses are ramping up for the holidays, but can they rely on Canada Post to deliver? That's ahead. Canada Post has been losing hundreds of millions of dollars, but small businesses are relying on the mail service and other couriers to deliver products this holiday season. Small Business Saturday is tomorrow. Let's find out what possible Canada Post disruption means for Canadian small businesses. We're joined by Dan Kelly, president of the Canadian Federation of Independent Business. Dan, thanks very much. I guess the good news is that the rotating strikes and other action have been called off. They reached a tentative agreement.
Look, that is very good news. We're certainly not out of the woods, but the fact that Canada Post is now, it seems, fully operational is a giant relief to businesses that were depending on it for shipping this holiday season, and for those that advertise, use ad mail through Canada Post. That outage was huge. The impact was significant on a whole bunch of businesses involved in that game, and also those that depend on Canada Post for advertising their products in advance of the holidays.
You just surveyed small businesses. What did they say about Canada Post reliability?
Yeah, look, during the last postal strike in 2024, that month-long strike, small businesses lost $1 billion either through increased costs or lost sales altogether because private couriers didn't have the capacity to pick up the slack at that time. And so 13% of small firms said that they will never use Canada Post and did afterwards. They didn't return. And then this year, almost 2/3 of small businesses said if there was another significant strike, they would leave Canada Post for good. Now, we're fortunate that things seem to be calm at the moment, but there is still a big distrust on using Canada Post, and a lot of businesses have moved away, or at least temporarily are moving away, because they're not sure, given that not everything is resolved yet, as to whether there could be another sudden outage at Canada Post, preventing their goods from reaching destination before Christmas.
It's funny, I know this is kind of off topic, but apparently Nutrien, the giant fertilizer company, decided to put an export terminal in Washington state, partly because they were concerned about labor disruptions at the port in Vancouver and on the Canadian railways.
Look, this is the larger backdrop to all of this is we have seen more strikes in Canada, especially for critical transportation infrastructure, than ever before. And why is this happening all of a sudden? Well, over the last decade, the federal government has made more and more changes to Canada's labor law, giving unions more power, fewer balancing powers for employers, and then, surprise, we have all these strikes all of a sudden. And so ports are less reliable. We've seen railway strikes, airline strikes, port strikes, Canada Post strikes. All of these are federally regulated institutions, and that is the common link here. It is leading to the reputation of Canada as an unreliable trading partner because we don't have our act together on our transportation infrastructure. We're starting to become France.
That's interesting. Interesting viewpoint. Is there something here that Canada Post should learn from other postal services in other countries, Dan?
Well, yeah. One is that they do need to make the needed reforms to the model to reduce the frequency of mail delivery. What Canada's needed for some time, and we have known this for a full decade, we need less daily mail delivery, home delivery of mail, and more frequent delivery of packages. That's where the puck is going in Canada, and yet we've refused to acknowledge that. The federal government put the brakes on needed reforms the full length of Trudeau's administration, and I have to say I am starting to be more optimistic because we have three things happening. One, it looks like the union has finally woken up and realized the game has changed. Two, Canada Post has put a deal together that looks like it might be acceptable to the unions. And three, we finally have government saying that that they're going to allow Canada Post to make the cost-cutting reforms that is necessary for it to stick around. Look, Canada still needs a postal service. We need national distribution to every address in the country. Small firms count on it as a low-cost form of delivery, and we can still have that with mail and packages. Less frequent with some, more frequent with others, if we can get Canada Post costs under control. And now the federal government seems to have greenlit those changes.
It's interesting. So Canada Post still the cheaper option in many cases when it works.
It can be a fantastic option. And look, even private couriers use Canada Post for that final mile. If you're sending something to a remote or rural community, it is Canada Post that, even for private couriers, delivers to the final destination. So the service is still very much needed. I know those of us in cities feel like we're less dependent on Canada Post, but that's not the case for the entire country.
We'd better go. Dan, thank you very much indeed. And I guess
anytime at all.
And we all should make an effort, get out to a local small business, spend some money this weekend.
You got it. Small Business Saturday tomorrow.
Thanks very much. Dan Kelly, president of the Canadian Federation of Independent Business. Still ahead, Black Friday in full swing, but apparently some shoppers are underwhelmed. We'll hear from Bloomberg's Emily Cohn on what's going on this year. Black Friday's in full swing, retail highlight of the year. Let's check in with Bloomberg's Emily Cohn. Emily, thanks for giving us the time. Apparently, shoppers kind of underwhelmed this year and unimpressed by the Black Friday deals.
That's accurate on one camp. I would say we saw a bit of a tale of two retailers situation where, generally speaking, shoppers seemed underwhelmed, disappointed in the sales, said that the discounts that they saw did not counteract the price increases that they've seen throughout the year, and not enough to get them to shell out take out their wallets. On the other hand, though, we saw huge crowds at stores, which I don't know if you've ever heard of. Addicted was a big one. Addicted as a teen retailer tends to be at malls. Hollister, Bath and Body Works, those brands that have a big showing on TikTok have a lot of teen 20-something fans. They seem to draw the crowds today.
Consumers say they are actually budgeting more this year than in years past.
We saw that. We spoke to a lot of shoppers earlier this week who had color-coded spreadsheets, and they were tracking prices, and they had budgets, which they had never had before. We also saw shoppers who were prioritizing themselves and stocking up on essentials, things they needed, things like sunscreen, mascara, things that they would have bought anyway throughout the year, buying them now while they're on sale, which I think speaks to the health of the consumer and the general economy.
Some stores seem to be short on staff, or shoppers saying it's harder to find someone to help them.
We did see that, and we went into this knowing that seasonal hiring this year was at its lowest in years, and we saw some signs of that. We saw shoppers who said that there were fewer cash registers open, the lines were longer, it was harder to find a worker around to help them. So that is an interesting reflection potentially on the labor market, of course.
I don't want to turn this into an advert for Apple, but they manage, as you know, to have employees walk around the store with a handheld thing for cashing you out. But other retailers, it seems to be just beyond their abilities.
Yeah, and you're competing with Amazon. Like, what's stopping you from just pulling out your phone and buying it right then and there on Amazon if there's no one around to help you? I think Apple is a retailer that knows that and does a really good job at stopping you in your tracks when you walk into the store.
I'm a cranky old guy. I have been known, if there's a big lineup at the checkout, just to put the stuff on the shelf and walk out. I'm not waiting to give you money.
Yeah, or pick up this and you can just do it right there.
Yeah, retailers need to get their act together. Anyway, but we all have to remember, be nice to the staff, though. They're rushed off their feet at this time of year. Thanks very much indeed. It was great talking to you.
Thank you for having me.
Emily Cohn.
Happy holidays.
You too. Have a great Thanksgiving. What's left of it. Emily Cohn of Bloomberg. Okay, let's take a quick look at the markets. Before we go, we'll start off with the S&P 500. And we'll look at some of the stocks that have been moving up today. There's the S&P, still not quite at a record high, but we did see some strength in Intel. I can't remember the symbol for Intel, but somebody in the control room can. INTC. SanDisk, another tech name, seeing some buying. Western Digital was also up, and Moderna. mRNA. Interestingly, we did see some selling in a stock that has surged over the past year. Eli Lilly was among the decliners in U.S. trading. Yesterday, I think it was on commodities, we were talking about the fact that some Americans are postponed their weekly diet suppression shot, GLP-1, so that they could really go at it for the Thanksgiving feast. Anyway, Lilly down a little bit. Let's have a look now at the Canadian market, because it is trading at record highs, moving, you can see there, above 31,350 in new record territory. Thank you very much indeed for watching Trading Day.